Welcome to this deep dive into 10 crucial news items from late March 2026. Our mission today is simple, really. We want to show you why the era of easy money is essentially over.
Yeah, totally over.
Right, and how a jarring contrast has emerged between short-term macroeconomic pain
Yeah.
and these massive long-term structural milestones. Because right now, Bitcoin is stuck. The Middle East is tense, oil is pushing past $100 a barrel, and retail investors are just terrified.
You're panicking and you look at the sentiment.
Exactly, but behind closed doors, well, Wall Street giants and massive corporations are quietly gobbling up the last remaining supply of the most finite asset in human history. Okay, let us unpack this.
It really is a tale of two markets right now. On surface, I mean, the numbers look grim because we are in a classic capitulation phase.
Right.
You have Bitcoin being squeezed near $67,000 by a really hawkish Federal Reserve. But under the hood, the foundation is solidifying faster than ever.
Exactly. When you see that $67,000 price tag, it is like so easy to panic. But a historic supply milestone just hit this week. The 20 millionth Bitcoin was officially mined.
Oh, wow.
Yeah, there's only 1 million left to be issued for the rest of human history. Obsessing over today's price action is like, complaining about a rainy day while completely ignoring climate change.
That is a great analogy.
The structural climate has changed. The rain is just temporary retail panic, but the climate is an absolute unchangeable drought of new supply moving forward.
What is fascinating here is how the scarcity narrative is actually intensifying among long-term institutional holders. They are looking at that 20 million mark, doing the math, and, well, they're completely ignoring retail sentiment.
They really are, and that institutional belief totally explains why corporate giants are aggressively building right now. Like GameStop just released their 10K filing.
And the rumors were true.
Yeah, they confirmed they still hold 4,710 Bitcoin, which is about $368 million. But they aren't just sitting on it. They're actually using it to collateralize a covered call option strategy.
Right, so they're getting paid a premium by letting other investors bet on Bitcoin's future price. And they use their own massive Bitcoin stash as the safety net, which perfectly illustrates how utility is expanding regardless of the spot price.
Exactly.
We are also seeing Anchorage Digital integrating TRON to give institutions regulated custody of those assets. And Aave is expanding its decentralized lending to the OKX layer.
The financial plumbing is being laid down so rapidly. But here is where it gets really interesting. We are even seeing traditional banking secure the physical network hardware.
Oh, right, the Core Scientific deal.
Yes. JP Morgan just expanded a credit facility for Core Scientific, the largest public U.S. miner, to a staggering $1 billion. But wait, if JP Morgan is throwing a billion-dollar lifeline to massive miners while smaller, less efficient operations get squeezed into bankruptcy, aren't we just replacing decentralized networks with Wall Street monopolies?
It certainly looks that way, and it is a critical concern to raise. But we really have to look at the underlying mechanics here. Infrastructure at this global scale requires massive, sustained capital to survive bearish phases. I mean, the hardware has to keep running to secure the network.
Right, the servers literally cannot turn off.
Exactly. Without that traditional finance lifeline during a macro downturn, the servers securing the decentralized system would literally have to shut down. So it is sort of an uncomfortable marriage of necessity.
So traditional finance is keeping the lights on. But the regulatory landscape driving all this alternative market growth is absolute chaos right now.
It is a complete mess.
We saw the leaked draft of the Clarity Act, which includes a yield ban on stablecoins. Think about it. If you can earn a 5% yield keeping your cash in a stablecoin on your phone, why would you keep it in a traditional bank paying practically zero?
You wouldn't. Nobody would.
Right. This ban is Washington's attempt to trap your deposits inside traditional banks so they don't face a massive liquidity flight. And it has sparked a massive backlash from Circle and Ripple.
And that regulatory friction is compounding because David Sachs just stepped down as the White House crypto czar after only 130 days.
Wow, that was fast.
Yeah, that exit leaves the U.S. Strategic Bitcoin Reserve and the Clarity Act completely in political limbo.
Because Washington is stalling, developers are realizing they just can't rely on friendly regulations. That is exactly why Ethereum is rushing its DevNet 5 Glamsterdam upgrade, specifically EIP 7732.
To make the network immune to government censorship.
Exactly, just in case regulators turn hostile. Meanwhile, prediction markets like Polymarket and Kalshi just exploded to $21 billion in monthly volume.
If we connect this to the bigger picture, the data shows that volume isn't even being driven by crypto prices.
Wait, really? What is driving it?
The primary driver of that $21 billion was geopolitical bets, specifically regarding U.S.-Iran tensions.
Wow. So what does this all mean for you, the listener? It means stepping back from the daily weather of red candles. The ecosystem isn't shrinking. It is evolving into the bedrock of the digital economy.
Yeah, with 20 million coins officially out there, the door on the era of accumulation is rapidly closing. The institutions are securing their positions and their infrastructure.
They're preparing for a future where hard assets rule. Which leaves you with this to think about. If prediction markets are now seeing more volume on complex geopolitical outcomes than they are on digital asset prices, has the blockchain officially transitioned from being a speculative casino into the base layer for global truth?
That is a heavy thought to leave on.
Something for you to mull over until next time.